Financial markets continue to digest the potential implications of the Pfizer-BioNTech announcement with regard to their Phase 3 COVID-19 vaccine trial. They're also welcoming the results of similar tests at Moderna, awaiting news of the AstraZeneca trial, and all doing that while seeking a definitive result from the US presidential election. Further good news on vaccines could help markets, as could a clear-cut count in America. Equally, some would say the chances of President Trump going quietly into the night are pretty slim, and that while there is still also a lot of work to be done in terms of trials, regulatory approval and logistics before a vaccine becomes a reality. One way of tracking near-term market sentiment is the so-called VIX or Fear Index in the USA, which looks at expected volatility in the next 30 days through the lens of the options markets. The index has been around since 1990 and its lifetime average reading is around 19. Anything above that, and stock markets are generally edgy. Anything below it, and they're feeling calm, even positive. And generally speaking, extreme readings have actually been useful contrarian indicators. We'll see how it works out this time around, but with the VIX having come rattling down from 40 in the week before the US election to 23 as I record this, it does seem that nerves are settling. This may help to explain why markets are rallying with the US at a fresh all-time high, although it also means any setbacks on the political or vaccine fronts could provoke sharp reactions. Another gauge of how the election result is playing in America will come in the form of the latest monthly consumer confidence reading from the Conference Board. This is due out on Tuesday the 24th of November. The October score was 100.9, down a fraction from September, and way down from 126 the year before. Note how the US stock market, as benchmarked by the S&P 500 index and the consumer confidence indicator, have tended to move in lockstep for much of the past decade or so, although the pandemic now seems to have taken care of that trend. The past is no guarantee for the future, and it will be interesting to see how the people whose spending drives the world's biggest economy view the world right now, and what effect, if any, that has on the stock market, or indeed whether it's a rising stock market that gives them the consumer confidence to spend. Now back home, we have a pretty busy week ahead of us in terms of corporate news. Around half a dozen FTSE 100 firms are due to publish results or a trading statement, and a long list of mid to small cap companies are scheduled to do the same. Firms which may be worthy of note because of what they have to say about their own business or industry or even the wider economy include the following, though please do note some of the dates may be subject to change. So we've got Compass, Pennon, Intertek, CRH, AO World and Cranswick on Tuesday the 24th of November. Melrose Industries, United Utilities and Babcock on the 25th. Life insurer Aviva and drinks company Britvic on the 26th. And newspaper and online publisher Reach will close out the week on Friday the 27th of November. But the company which just may cause the biggest fuss in the coming week is Severn Trent. The utility, which provides water and water treatment services to around 8 million people and 4.5 million households across the Midlands, is scheduled to release its first half results on Thursday the 26th of November. As you might expect perhaps of a utility, the shares have been pretty solid performers over the past year, rising 9%, while the FTSE 100's fallen by around 15% over the same period. These interims will be Severn Trent's latest chance to confirm the strengths of its business model, especially as this is the first year of the AMP7 regulatory cycle that runs through to 2025. The firm's also had to contend with the pandemic, and on those 2 points, remember that the regulator Ofwat quickly approved Severn Trent's spending and pricing plans for AMP7, which should provide some visibility on cash flow. And Severn Trent's first estimate for the hit from the pandemic was some £80 to £85 million in revenues, due to lower business consumption and also the possibility of increased bad debt as households struggle to pay their bills if someone's been unlucky enough to lose their job or at least some portion of their income. Analysts will be looking to Chief Executive Liv Garfield for comments on both of those issues and also how the first half stacked up relative to the company's guidance for the full year, which was given alongside last May's annual results. The key points here were a drop in full year sales of around 5 to 6%, higher operating costs due to COVID-related bad debts and costs associated with wastewater management, although cost efficiencies could help here. And that combination underpins analysts' forecasts of a 6% drop in pre-tax profit across the whole year to £288 million on a stated basis. So, I guess that rate of decline is a possible benchmark for these first half numbers. A further big number to note is capital expenditure. This reached its highest level in more than a decade last year at £800 million, as Severn Trent got ready for the end of the AMP6 regulatory cycle and for the start of AMP7. Spending's forecast to drop to between £430 and £510 million this year. And the final figure to watch is the dividend. always a key point for any utility. Under AMP6, Severn Trent's policy was to increase the dividend by retail price index RPI inflation plus 4 percentage points. Under AMP7, the goal is less ambitious, namely to raise the dividend in line with CPIH inflation, which at the start of the year was around 1.5%. The first half payment a year ago, but for your benchmark, was 40.03 pence per share. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.